WeGetNotes.com does not provide legal, investment or tax advice. The material contained in this and every other communication from WeGetNotes.com is for educational purposes only and is not a representation, guarantee or promise of the results you may experience. Any historical performance data that may be contained in this communication is based on the information presently available to and on the beliefs and assumptions of the management at WeGetNotes.com and does not guarantee future or any other results. Any pro forma or other forward-looking projections that may be contained in this communication are based on current expectations and are based on the information presently available to and on the beliefs and assumptions of the management at WeGetNotes.com. Actual performance may be materially different from that which is expressed or forecasted. Please consult with the independent professionals of your choice should you need or desire professional advice. The material contained in this and every other communication from WeGetNotes.com is not and shall not under any circumstance or for any purpose be considered as an offer to sell any security or security-related product or instrument.
Why would anyone in his or her right mind buy a non-performing note? That is, a note on which the borrower has stopped making payments. To answer this question, let's look at an example of a note which is secured by an owner-occupied single-family residence. Because we won't buy a non-performing note unless we can do so at a very deep discount, an amount that is significantly lower than what is owed to the institutional lender, we have much more flexibility in workout strategies than did the institutional lender. Let's look at a representative case study. Long before we get involved in the deal, the borrower purchases the home for fair market value, in this case for $80,000. At the time of the purchase, the borrower made a 20% down payment, $16,000. And the borrower then took out a loan for the balance to complete the sale, a note in the amount of $64,000. After the borrower purchased the house, the value of the property declined significantly. This has occurred in millions of similar cases nationwide. More on that later. Back to our borrower, the house is now worth $30,000, but the borrower still owes $60,000. What does the borrower do? Stops making payments, of course. Why would he pay a $60,000 loan on an asset that's only worth $30,000? We are able to pick up the note for $10,000. After the purchase of the note, we're in the position of having paid $10,000 for a note with a balance owed of $60,000, but which is secured by a property which is only worth $30,000. Unlike the bank, the institutional lender, we can modify that note to the current fair market value of the property, $30,000. After we modify the loan to $30,000, we simply collect principal and interest payments until the loan has been fully paid off. We call this the buy and hold of real estate note investing. Experience has shown that about 30% of this type of case will resolve with a loan modification. In cases where the loan does not modify, our next strategy is to seek a deed in lieu of foreclosure. In exchange for a deed in lieu of foreclosure, we will take a number of actions which will have significant value to the borrower. First, we will waive the right to pursue a foreclosure action, or will stop any foreclosure action which may have already been initiated. Next, we will instruct our loan servicing company to stop making negative reports to credit bureaus for missed mortgage payments. Both of these actions will significantly assist the borrower in beginning the process of credit repair. Next, we'll offer the borrower a small amount of money, typically $1,000 or so, which will be payable after the borrower gives us the deed in lieu of foreclosure and surrenders the property to us in good condition. Next, in states that allow deficiency judgments, we'll waive the deficiency judgment. In this case, our sample case, that alone is a value of $30,000. Our offer for a deed in lieu of foreclosure is clearly an offer that no reasonable borrower can refuse. A deficiency judgment is a court-ordered judgment that would obligate the borrower to pay the difference between the amount owed on the note and the amount obtained at a foreclosure sale. In our example, the borrower purchased the property for $80,000, financing $64,000 of that purchase price. After completing the purchase, the borrower made payments which reduced the principal amount owed on the loan by $4,000, leaving an outstanding balance on the loan of $60,000. Now, however, at the time of a potential foreclosure sale, the property is only worth $30,000. The difference between the $30,000 that could be obtained for the property at a foreclosure sale and the balance due on the note, $60,000, represents the amount of our potential deficiency judgment. The end result is we end up having paid $11,000 for a $30,000 property. Experience has shown that about 30% of such cases will resolve by way of deed in lieu of foreclosure. When deciding what we are willing to pay for a note, the valuation process will always include a projected cost of foreclosure. In our example, if the borrower did not want to modify the loan and also did not want to take advantage of our offer to accept a deed in lieu of foreclosure, we might project the foreclosure expense at $5,000. In this scenario, we would have $15,000 into the property, which is worth $30,000. Experience has shown that about 40% of cases will resolve by way of foreclosure. Many traditional real estate investors seek to invest in REOs, real estate owned by the banks. These are properties secured by notes that went into default, where the banks themselves foreclosed on the properties rather than selling the notes to investors such as us. There are estimated to be some 500,000 REOs nationwide. Rather than foreclose on these loans themselves, institutional lenders such as the banks are selling these notes to investors such as us. There are estimated to be some 10 million delinquent mortgages, non-performing loans, nationwide. This preference of institutional lenders to sell non-performing notes to investors such as ourselves, rather than foreclose on these properties and convert them into REOs, creates a 20-to-1 ratio of NPNs to REOs, creating enormous opportunity for investors such as ourselves. Not only is there more inventory of non-performing notes than there is inventory of REOs, there's less competition for non-performing notes. How many people have you run into at your local REIA meeting who want to buy REOs? And how many people have you run into who want to buy non-performing notes? Abundant inventory of non-performing notes and less competition for those deals makes an ideal business environment for note investors. Not only is there greater inventory of non-performing notes compared to REOs, and not only is there less competition for these notes as compared to the REOs, the profit potential for non-performing notes is much greater than the profit potential for REOs. So why would anyone consider buying a non-performing note? The answer is simple. Engaging in the note business is simply a backdoor method of acquiring a lot of real estate very inexpensively. If you would like more information on the exciting opportunities that were discussed in this video, please visit us at wegetnotes.com or call 800-394-3250. Thank you.